So the rand seeing some weakness come through in yesterday's session and of course tracking the weaker euro. But having said that, the dollar's come under some pressure as well. So what are you reading into the currency movement we're seeing when it comes to the rand relative to those crosses right now?
Good morning, Alishia. Yes, yesterday we saw the rand initially weaken on the back of the poor GDP figures that we saw domestically. We also had, as you mentioned earlier in the show, some poor confidence figures, both out of Europe and the States. And basically, we just saw the rand initially yesterday falling victim to rising interest rate cut expectations on the domestic front, and of course, soured international sentiment associated with those disappointing confidence figures abroad. Yeah. But then everything turned around after that FOMC minutes were released last night. They were very dovish, and the market once again started to price in an inevitable bit of more monetary easing coming from the Federal Reserve. Of course, we don't know the specifics as to what kind of monetary easing is in the pipeline, but it does look ever so more likely that the Fed will have to pull the trigger in some or other form in the coming weeks. Of course, so that's buoyed international sentiment and, of course, buoyed the rand.
Of course, that prospect of monetary easing in the US would further cement its status as a funder of carry trade. So let's look at implications, more in depth when it comes to the kind of activity we're more likely to see if further easing does come to the fore.
I think we've discussed this a couple of times on the show before. There's various options the Fed can deploy. One, and probably the most likely, would be to actually reinvest the maturing bonds that they've bought into longer dated securities, and in so doing basically flatten your yield curve towards the long end of the curve, make long-term borrowing costs as low as possible, and try and stimulate demand that way around. Just broad-based quantitative easing, buying bonds across the maturity spectrum. I don't know if that's necessarily going to be the path going forward for the Fed, because we've seen repeatedly in the past that every time we've had this quantitative easing, what we've really created just is asset bubbles in commodity markets and emerging markets, and really we haven't seen strong consumption and business demand coming through in those Western countries. So I think there might be a little bit of shifting the focus as to where the monetary easing will take place across the yield curve. And then, of course, there could be some other changes like return on reserve holdings that the US banks have. Again, trying to get borrowing out to the consumer and to businesses. I think that's the crux. We need demand to come through from households and businesses, and that's what the Fed is going to be trying to do. Just sort of broad-based monetary injections, as I say, just plays into the hands of the speculators.
With that in mind, Michael, and with you highlighting what we need, in the meantime, how do you actually sift through all the news flow that we're seeing and decipher between the noise and the actual data or phenomenon that you need to actually take into consideration?
Well, one of the key things to look at is, of course, what's happening to the US housing market. Is there any improvement there? So far, we've seen very little improvement. The other thing to look at is things like consumption expenditure and, of course, the labour situation in the States. This week, we've got a deluge of labour data out of the States. It's starting this afternoon with the ADP employment report, and, of course, it culminates with the all-important non-farm payrolls tomorrow afternoon, coupled with the US unemployment rate. What we want to see there is improvements in terms of job creation. What's very alarming in the States is the fact that a lot of people have actually stopped looking for work. So even though your unemployment rate might decline, the key question to ask ourselves is it declining because people have stopped looking for work, or are we starting to see some light at the end of the tunnel and people are taking employers on board? I tend to favour the latter, at least the former, and I think that we are still going to be going through some tough times. And only once we see an improvement on that labour front, when we see consumer spending coming through aggressively, or when we see an actual improvement in the US housing market, I think we are just all just waiting for the Fed to inject more liquidity, because really growth is going to be soft. And you've mentioned that already with those IMF forecasts.
Of course, looking at growth, we had those GDP numbers for the second quarter disappoint yesterday, and with that, a lot of attention being placed on the rates outlook once again. Rates in the fell yesterday, with the market raising the chance of a rate cut over the next 6 months to 60% from 50% prior to that release. Michael, have you changed your forecast at all?
We haven't as yet. We're still holding out for a hike towards the third quarter of next year. We're not pricing another interest rate cut at this stage of the game. Again, it's very difficult to imagine that the Reserve Bank is going to be cutting rates when inflation is trending higher, and also the whole mechanism for monetary policy has been watered down. The transmission mechanism from an interest rate cut actually to demand is not as strong as what it used to be, because people aren't borrowing and lending isn't taking place as much. So really, what are we going to achieve by a one-off 50 basis point cut at this stage of the game? I think the Reserve Bank has played its hand. It's cut interest rates aggressively in previous quarters. Now we've got to wait for that to take effect. It is already starting to take an effect. We see that wealth amongst consumers and households is better placed, but they're reluctant to go out and spend just yet because of the job situation. Job security remains key to demand, and I think that's where we've got to see the improvement. I think cutting interest rates at this stage of the game is just a little too late.